Hi, I'm Steve Clapham. Welcome to the Behind the Balance Sheet podcast, where we meet leading investors and commentators and educate ourselves about the world of investing and the world at large. Our mission is to remove some of the mystique around investing and improve our understanding of what makes a successful investment or indeed an unsuccessful one. Our goal is to inform, educate, and entertain. We hope you enjoy this and every episode.
Behind the Balance Sheet and affiliates and podcast guests may own shares or have an economic interest in securities discussed in this podcast, which is aired for your education and entertainment only. Nothing in this podcast should be construed as investment advice or relied upon for investment decisions. Always do your own research.
I've interviewed a number of people in this podcast who describe themselves as value investors. It signifies, I think, a mindset and a philosophy more than anything, as they all run their portfolios and choose stocks quite differently. That philosophy includes a willingness to underperform 1 year in 3, an acceptance that they won't have the glamour of the growth investor in the boom years, but they'll make up for it in the down years, and a focus on buying stocks cheaply, however they define that. My guest today, Jennifer Wallace, is definitely a value investor. In this episode, she explains her investment philosophy, which is buying high-quality companies on the cheap, often when things have gone wrong. Jen finds these gems for her 30-stock portfolio by combing value line, just as she did when she trained under famed value investor Bob Bruce. Her focus is on the numbers. She talks here about CEOs and IR heads being great salespeople, promoting their stocks, and how she avoids being sold to by that solid focus on the numbers. She likes her portfolio to be net cash or with very low leverage, to have returns on equity of over 30%, and to be in a free cash flow yield of 10%. She buys stocks which are overlooked, often because they're not in passive indices, or where there are not enough active value managers to facilitate price discovery. But by requiring low cash flow multiples, she can rely on the cash flow to deliver the return. Either management will return cash to shareholders, or about 25% of the time she receives a bid, often from private equity, attracted by the cash generation and a starting conservative balance sheet. It's easy to see from our conversation why Jennifer has delivered to her partners an 8x return since inception in 2009, even while holding substantial cash balances, another tenet of her philosophy. You're sure to enjoy our conversation. So, Jennifer Wallace, we met in Omaha, almost a year ago, and I'm really pleased to welcome you to the podcast. We met in New York just a couple of weeks ago, and I don't really know very much about you, but I always ask guests, did you always want to be an investor?
Well, first of all, Stephen, thank you for having me. It's a pleasure to be with you today. And on the question of did I always want to be an investor, the firm answer is no. Most importantly, because I didn't even know that this profession existed when I was young, and certainly not in college. I went to a very liberal arts undergraduate school.
Which one?
And I went to Columbia College, which has, a world famous core curriculum, but it is humanities driven. And in fact, only recently have they begun to offer any kind of business or technical kind of courses to undergrads. And I worked in investment banking out of college, still shocked they hired me because I knew so little about anything finance or financial markets, and then went to business school. And it was in business school where I learned even basic things like the math behind a discounting calculation on your Excel. I didn't, I sort of lights went on for me about the work I had been doing for the past years, kind of punching away at my computer and learning, sort of realizing that. I was fortunate in business school to become close with a professor by the name of Bruce Greenwald, very well known in value investing circles. And he is the person who is credited with bringing the value investing program back to Columbia Business School. And he said to me, there's a class that called value investing that you need to take next semester. And I said, great, I'll take it. What's value investing? And it was only through that course that I learned, A, that this was as interesting a potential career as it is, and B, that there were all these famous world, kind of legends out there that I got to listen to. And the course spent about 6 weeks focused on Bruce Greenwald and Roger Murray teaching us the basics of financial analysis and understanding what a valuation means and what constitutes a value investment. And the last 6 weeks listening to legends speak, from Seth Klarman to Mario Gabelli to Michael Price to Warren Buffett, you name it. We were really exposed to some pretty special people. And that, for me, was when the light went off. This is what I think I want to do.
And so Warren Buffett was one of the guest lecturers. I don't know what you call them,
Yeah.
Adjunct professors or something.
No, he was just a guest lecturer for one course, one class.
And what was that like? Did you know that this was, you were in the presence of somebody great? Or,
Yes.
Some time ago.
It was some time ago, but yeah. By then I was not so naive and clueless. So by then I also realized what an incredible experience and opportunity it would be, or it was. But also even in the presence of like a Seth Klarman, you're in the presence of an unusual intellect and somebody who is truly great.
Interesting, because there seems to be much more emphasis in America about having studied finance. And here, it's very common for people to have liberal arts degrees and go into investing without any business school training, and you just learn, on the job. Do you think it's necessary to study at a university, or do you think it helps?
So I think I often joke. I was a political science and psychology major undergrad, and I think investing uses as much psychology as it does finance. That being said, if you don't know how to read an income statement or a balance sheet, I think it would be very hard to do financial analysis. But the financial analysis that you do is not advanced math. And certainly in the way I invest, it doesn't involve complex options, straddles, or butterflies or anything like that. So, those kind of courses aren't things that I use in my day-to-day life. And really, it's basic financial analysis in the form of understanding what the financial statements are telling you. And then also, for me, it's psychology, managing your own psychology and human nature, and also understanding the psychology of markets to the best of my ability.
And you spent some time at McKenzie, I think. What was that like? And did that help?
So I went to McKenzie very specifically to sort of broaden my scope and perspective. Having been an investment banker, I knew kind of the experience of processing deals. Having been in business school, I knew the experience of sort of academically learning about investing. But what I felt I lacked was a perspective inside companies. Because when I invest, I'm thinking about a company. Buying a share is really buying a piece of an operating business. So I think there are plenty of ways to invest, but that's the way I invest. And so having not had the inside exposure, I felt that was a piece that was missing. So I spent from 94 to 98 in consumer healthcare media group at at McKenzie, serving clients, from pharmaceutical companies to HMOs to cable companies to retailers, and was able to get kind of an inside view of how companies really work. And I think that has been additive to my investment approach. Anyway, I was fortunate to have the opportunity to kind of off ramp out of McKinsey and into a buy side role.
And what was that? Where did you go after McKinsey?
I was hired by a man by the name of Bob Bruce, who was a very under the radar value investor. He called me at the suggestion of Professor Greenwald, said, if you want to learn how to buy high quality companies at a discount, come work for me, which is a pretty compelling thing to say. But what made his offer particularly compelling is that he had worked for many years with Warren Buffett. He was the chief investment officer at Fireman's Fund when Warren and Jack Byrne and a few other people got involved. So I joke, he had the red phone to Warren for many years. So that made his offer substantive. And so he was managing money for a family office, Bob Bass, out of Texas. And I got to go work for him. And it was sort of an old school apprentice style relationship. I sat at his elbow. We shared an office all day, every day. And my first day on the job, he put me in a conference room with a glass door and he said, don't come out. He left me with a pile of value lines and said, don't come out till you have something interesting to talk about. And he didn't mean with the best next best investment idea. But what he did want me to do was learn how to let the numbers tell a story. The numbers will tell you if a business is interesting, if a business is good, and if the management team does smart things with the cash that they generate. And so I have become quite addicted to value lines. I still use them today.
They still print it. I didn't even know it was still around.
It is. It's online now, and you have to print a PDF. They don't send you the books, but I save all my old, on the thin little newspaper kind of print. But I think it's a great snapshot of a company, and you could cover up the entire commentary and just look at the numbers, and you will know the questions to ask. And you will begin to start, be able to make conclusions about the quality of the business and the management team.
Well, I hope you're enjoying this episode. And if so, you're bound to enjoy our free newsletter on Substack. It's a weekly email I send out each Sunday morning on interesting investing related topics. Just visit behindthebalancesheet.com and hit that little sign up button on the top right. And while you're there, you should check out our fabulous online investor training school. Hundreds of students have taken our flagship Analyst Academy course, which teaches you everything you need to become a serious equity investor. And if you're a professional investor, we also run a forensic accounting course for institutional clients and a cohort-based course for smaller funds and for serious amateurs. Email me at info@behindthebalancesheet.com for more information. Why do you think that's not sort of standard? Because, if you asked somebody outside investing and they would say, well, obviously that's what you would do, but it doesn't seem to be that common. The people that I have in this podcast tend to be of that sort of genre, but I know lots of people who invest without paying much regard to the numbers.
I would find it very difficult to give capital to somebody who invests without regard to the numbers, A, and B, I don't know what kind of investing that is, because all investing should be, quote, value investing. Value investing is nothing more than the idea that you figure out what something is worth and you wait for an opportunity to buy it for less. And you hopefully have a margin, that's your margin of safety in case you're wrong about what it's worth, recognizing that the future is uncertain and any kind of future projections will not necessarily be 100% accurate because nobody has a crystal ball. And so if you invest without regard for the numbers, I'm sort of speechless. I don't even know what to say about that.
Well, I mean, I'm saying without regard to numbers. I mean, I don't think people actually do that. But I don't think people place enough emphasis on the numbers, and I noticed that quite a lot. When I go around, I do this forensic accounting training, and when I go into clients, there will always be, I'll usually go into a group of 7, 10 people. And the different analysts, well, there will always be somebody who's a bit of a numbers geek, but there will always be others that are much less focused on the numbers. Always slightly surprising me. But I was going to ask you, you're not what people think of when they think of value investing. You're more of a quality investor. So just talk about your investment style and how you derived that.
Sure. I would actually say we're deep value, we're long biased, and at times we hold significant amounts of cash. We're focused on public equities of generally global businesses. And at the end of the day, we come to work every day with one objective, which is to compound our partners' capital safely. And we do that by buying common stocks of what we believe are uncommonly good companies. So that's where you get your idea that we're very quality focused. But we are only interested in buying those companies when we can find them at bargain prices. So, there's GARP, there's whatever. I would say we're VARC, which is value at reasonable, even high, if we can find it, quality. But at the end of the day, I would argue that investing boils down to two questions. How good is something on one hand, and how much do I have to pay to get a piece of it on the other? And in my experience, successful investing happens sort of in this effective trade-off between quality and value. But we are looking for major price dislocations. We're looking, honestly, at stocks that have something wrong with them typically because they just don't get cheap enough for us to be interested unless there is something wrong, real or perceived. And so because of this, we avoid leverage. Both our portfolio is an unlevered portfolio and the companies we invest in generally have low to no debt because the situations that attract us typically occur, as I said, when the company or even its industry or the economy broadly is facing headwinds and uncertainty. And it's in those situations like now
you're enjoying yourself now then.
A little bit. So this sort of the strength though of a company's balance sheet is what we call kind of a runway for recovery. And that is what allows a company to invest incremental capital at high rates of return. And at the end of the day, helps to separate truly attractive investment opportunities from stocks that might be cheap on a pure multiple basis, but deservedly so. So I would argue that this sort of element of balance sheet strength is a very important aspect of quality in our portfolio, as is the fact that we're looking for management teams whose incentives are aligned with shareholders and who've demonstrated that they're good allocators of capital. Because at the end of the day, if you're looking at an unlevered company, maybe even one that has excess cash, you want to be certain that they're going to use that cash well, because from a mathematical standpoint, you're sort of counting it as your own in a valuation sense. So what I would say is we're combining a very strict discipline about value and quality with a basically unconstrained mandate around industries and cap sizes. We're benchmark agnostic. We're fairly concentrated, 25 to 30 stocks most of the time. And then we don't invest in certain areas of the market, including most financials, utilities, REITs, just because the leveraged nature of those business models don't really meet our quality requirements.
But what happens if you've got the opportunity to buy a not very highly levered REIT at a massive discount to assets? Would you not be tempted by something like that?
I've never seen that. REITs use quite a lot of leverage in the basic business model, and then they pay it all out. That's not something that I've ever seen. Surely, if I saw something like that, I would look at it, but I've never seen that.
And financial, so you wouldn't buy an asset manager, or is that just banks and insurance?
It's really banks and insurance companies. It's companies that have leverage as their basic business model, right? We take in assets, and then we make loans, or we, invest. I think particularly on the investment side of both financials and even insurance companies, it's very hard to know from the outside what they own and how safe it really is. I also, as we know, and have seen, there is a duration mismatch in many cases between what they hold and what they, their assets and their liabilities. And so, I just think particularly banks have been poorly regulated and poorly run in many cycles. We find it out in many cycles.
No, absolutely. I mean,
Over the course.
the problem with these things is they're black boxes, aren't they? So you can do all the research you want, but you never really understand what's going on. And the chances are,
And agreed. Yep. And even they don't really know. I mean, as we saw in the financial crisis, there were a lot of companies that thought they had AAA investments, and they were, not safe at all. They went to zero.
Reading Duncan Maven's book about Credit Suisse made me, really confirmed my fears about the banking sector. I mean, I worked at one point for a financials hedge fund, but I did all the non-financial stuff. And when we went to lunch, my colleagues would talk, and they might have been talking a different language. Quite funny.
The CLOs and the this, that, and the, yeah.
And you're prepared to hold cash. Just, why do you want to do that? Because, I mean, most of your clients, they're paying you to invest their money. It means you're making explicitly or implicitly a market call. Why do you feel comfortable doing that? I mean, do you think it's helped your performance or hindered your performance?
If you simply took our performance and grossed it up for cash, you could make the argument that holding cash has been a drag. But by the same token, we don't hold cash with an explicit call on the market. We hold cash in the absence of an investment. I do believe in general in equally weighted positions in a portfolio. And what we have found is that cash tends to accrue in the portfolio as markets go up, or as, I'll say we had something like 17% cash leading into Brexit. Now, who in the heck could have known that Brexit would end up the way it did? And in fact, that morning I had planned to take the day off, but all of a sudden Brexit happened, and came to the office, and we were able to add to positions and buy new positions with cash. Why do we have so much cash? We had cash because two stocks in the portfolio just earlier had reached our estimate of value, and one had been acquired. So we had, a lot of cash, more than average, and we were able to put it to work. And I would say that having that dry powder is a helpful, and has been a helpful component of our performance. And I do believe that you should be disciplined. You shouldn't just invest because you have it. Cash, I don't believe you should have cash burning a hole in your pocket. That said, we do have some clients who are, particularly like university endowments, and they have cash in their central portfolio. So
Sure.
they don't need us to hold as much cash, or in fact, don't want us to hold as much cash. And what we do for a client like that is that we'll have slightly larger positions. They hold the same stocks that the fund would hold, but they'll have slightly larger positions. And as a result, we'll have slightly, probably 50% to 60% the amount of cash.
And
That,
I mean, what's the most amount of cash you've ever had, and what do you have now?
well, we've been putting it to work. We're down to about 7% cash now, I believe, and we've had as much as 30. Very rarely. We've averaged about 12 over the last couple of years.
So that must mean you're more positive today than you've been.
It's funny. If you think about the things that we buy as humans, and you think about stocks, stocks are like the only thing we like better when they get more expensive. If you found a pair of great looking, expensive loafers in your favorite store that were $700, and then you went by one day and your size in your color happened to be on sale for 50 off, you'd jump at the opportunity. However, if you have a great stock of a fundamentally great cash generating business with an excellent management team, and one day you wake up and that stock is down 50% and your investment thesis is intact, people get panicked and they want to sell. So stocks are the only thing that I'm aware of that people like better and are more inclined to buy after they have gone up. And conversely, like less and are more worried, frightened when they've gone down. What I will say is we have added to existing positions and we are looking very carefully at some new positions, adding a couple of new investments. And, market downdraft is good for us.
No, sure. I mean, I understand this, although I've been rather aggravated by the amount of emails in my inbox saying buy the dip. I mean, it seems to be a very fashionable policy, and it's particularly in the United States. And obviously, the uncertainties. I mean, look, the market's down. I don't know. We're recording this on the 16th of April. The market's down 10, 12% from the peak. And you could argue, I mean, there's obviously a very bifurcated market, and there's lots of cheap stocks and lots of expensive stocks. So I think it's very hard to draw general conclusions. But, I would find it very difficult to go in and buy a Costco on 50 times or a Walmart on 35 times just because they're 10% or 15% off their high, because it seemed to me their highs are very high. I mean, conversely, I mean, there's some cheap things, but I'm just curious if you've got any sort of general perspective on what's happened recently, because this is the first recording I've done since the ill-named Liberation Day, and I frankly, I've read some absolute nonsense being written, and I think people kind of aren't working out that there's an economic implication of all this, and there's a significant implication for corporate earnings. I mean, what's your take on it all? And what sort of things have you been looking at?
So I would step back for a minute and say, there's sort of like two concepts. Buy the dip. What dip are we talking about, right? Are we talking about the market? You buy the market in total? Are we talking about buying the high flyers, the Mag 7s, the Costcos, whatever? It's hard to argue that these stocks have been anything other than safe havens in times of volatility until just recently. Things work until they don't work. But in my experience, buying a stock at 40 or 50 times earnings is not a great recipe for compounding capital safely. And if you think about it, you're buying something at, let's say, a 40 times multiple of today's earnings. That's 40 years of earnings that you're giving to the person you're buying the stock from. and that you're going to have to wait before anything comes to you in just pure, what am I really doing here? So in order to justify that, you've got to assume one of two things, or actually both. One is continued market dominance of that company. And if you look over the history of time, kind of 40-year dominance is rare, certainly not a given. So you can look back at the Nifty 50. Less than, I think, 40% of them are still even in the S&P 500. If you look at the top 10 stocks at the peak of the internet bubble, I think only one is still a top stock today. The assumption of perpetual market dominance, I do not think is a good one in most cases. So stepping back, I'd say like buying the dip, buying the market, not something I would argue for. But in a dip and in a broad-based market sell-off, especially if there is this sort of panic, if this discarding of things because people are nervous, you can find baby with the bathwater opportunities where the baby is tossed out with the whole bathwater, and there are great opportunities. There are companies that, in sort of smaller and mid-cap companies, not the Mag 7, U.S. companies that will benefit from the onshoring of, or even if you just look at sort of global supply chain duplicity that's going to have to happen, there's going to be, supply chain redundancy, not duplicity, I apologize, supply chain redundancy across the world. That, as you point out, will be potentially challenging from a company's margin standpoint, but from a national safety standpoint or security standpoint, you certainly can't have the optimized single source supply chains that we had prior to 2020. So it's interesting, but there are plenty of companies that we believe, regardless of tariffs or even after tariffs, already have a lot of negativity now priced in. Right. Names that we have been looking at for a very long time that were just not quite cheap enough for us that have now gotten a lot cheaper.
All right.
And their business fundamentals have not gotten worse.
And at the your year-end letter, you said your portfolio has an average return on equity of 30%, mainly net cash, almost all paying a dividend, 3/4 having recently done buybacks, and conclude that this combination of value, quality, and shareholder return is an excellent recipe for capital appreciation. Is that kind of the ideal combination that you look for? Is that the kind of the setup?
Absolutely. Yes.
Now, you've been around in the markets for quite a while, and you look like you've been around in the market for a while, but I know that you have.
You.
And I just wanted to ask you, I think it's very interesting, the change in market structure, because it's quite a different market from the market that we started in, right? And I just wondered if, David Einhorn sort of was talking about, he used to buy the stocks and wait for capital and fidelity to discover them, and then they would go up. And he said, no, there's nobody there at Capital or Fidelity buying these stocks, or if they're there, they don't have the same amount of money. And he gave up on that sort of traditional model. How do you sort of look at it? You're doing a similar sort of thing. You're trying to find these overlooked assets, and they do need to be discovered for you to get the re-rating, right? How do you think about that?
Yeah, first of all, I think David Einhorn is 100% correct. I've read his analysis and perspective, and I agree with it. I've also spoken to some of the same people that he talks to inform my own perspective. I would say in the tech bubble was the first time I became aware that it wasn't just fundamentals and re-rating and sentiment that drove stock prices, but it was also supply and demand and asset flows. Then it was sort of all the money going into the tech mutual funds. And you could see them come into the market every day at around 10 o'clock in the morning and start buying more of what they already owned. And then since the financial crisis, we've seen a market growth in passive investing and index investing. And that has created a set of supply and demand characteristics that has fundamentally changed market structure. And if all the capital is flowing to passive investors and it's coming out of active managers who presumably have undervalued stocks that they have to sell, making them more undervalued so that more cash can flow to passive, you can kind of get yourself into a rabbit hole of kind of despair, thinking, what now can I do? How can I ever make money? And my money will, my capital will also eventually flee to passive. Knock on wood. We hope that is not the case. But what we have concluded, quite similar to what David has concluded, is that you cannot simply invest with the expectation of a re-rating because of capital coming behind you. That is not the investment game, if you want to call it that anymore. I used to sort of worry as I noticed this sort of risk on, risk off. And as I thought about this growth of passive, I honestly never expected it to get to the magnitude that it is today. But I would think to myself, when a tree falls in the forest and nobody hears it, did it really make a sound? Well, you could take the same thing and apply it to our portfolio. Jenny has found a great cheap stock, but there's nobody else left to buy it. So how will Summit Street's investors ever earn a return, ever get paid? And I also used to think, well, so in a decade of, now it's been a decade and a half of value investing kind of underperforming so many other approaches, particularly, mega cap growth, how has Summit Street done so well in that environment being a deep value investor? And again, the conclusion is that we focus on something ever so slightly different, and we are not solely waiting for a re-rating. We are interested in companies that are cheap relative to the cash that they will generate. And when we're right, they generate excess cash and do wise things and shareholder-friendly things with that cash. So our companies tend to kind of be their own catalyst, right? They generate so much cash, they pay it to us in dividends, they shrink their share count, or they make strategic acquisitions that accrue to the benefit of shareholders. In those cases, cash is its own catalyst and the company becomes its own catalyst. We are not waiting for, or, the company becomes, an unlevered mid-cap company with cash generating potential is a very appealing acquisition target for a financial buyer or a strategic buyer. Something like 25% of the stocks we've owned since inception are no longer publicly traded because they've been acquired. So there are lots of ways that cash can be a catalyst, but it is important and has been a major contributor to our long-term returns because we focus on price to cash flow as our primary valuation metric. And when we're right about the cash flow we expect a company to earn, the cash becomes its own catalyst and the company's cheapness becomes impossible to ignore.
So two questions arise from that. One is, are there common characteristics to the companies that got taken out, that got acquired? Another is, I suppose that if that's kind of the focus, then you're unusually dependent on investing in good management. So I want to talk to you about the management in a minute, but have there been any common threads to the companies that have been acquired?
Nope.
Because Mario
Across the
Gabelli,
board,
he
no.
likes to buy things that will get taken over, right?
Yeah, I mean, he's talking about that private market value, and I think that's a great way to think about it. But no, I mean, the common thread is that they are bite size. The company, they're not so large, right? We've owned Apple and Microsoft back in the day when they were cheap. Neither of them has been acquired, but mid-sized companies. So I would say the common thread is that they're bite size. They have they generate excess cash, and they tend to be unlevered and have excess cash. But the appeal has been from financial buyers and strategic buyers alike over the years.
Oh, interesting. And then on management, so if you're buying companies that have got a lot of cash and are generating lots of cash, you're reliant on them doing sensible things with that. How do you always meet the management before you invest, and how do you judge them? You're a psychology major, so you're probably quite good at that, right?
There's a couple of thoughts I have. Look, I've been in this business so long. When I first started, Regulation FD wasn't even a thing. So you could actually go visit management teams and glean information legally that was not known broadly and that was valuable as an investor. With Regulation FD, I've noticed a pretty big shift in the sense that management teams have become more charismatic, more likable. I've never met a CEO that didn't think that their stock was undervalued. And, part of being a CEO and part of being a head of IR is now being convincing about that concept. So it's interesting over time that actually management teams meetings have become probably less valuable. What's more valuable and what I have always focused on is what they do with the cash. And you can look at that over years. You can say the company generated this, they did this. They've made these 7 terrible acquisitions, or they've made 2 great acquisitions. They did a massive share shrink, special dividends. So I don't think it's as important to listen to what they say as it is to look at what they've done. And if there's a big break between what they say and what they've done, sometimes that's a big red flag. And then every now and again, they'll do something totally that surprises us, and we will revisit our thesis.
Will you sell the stock if they do something you don't like?
Yes, 100%. People sometimes ask us if we are activists. I said, no, we don't have to waste our time. That is not our job to tell a management team. First of all, it's an uphill battle and you have to be willing to fight, but we're not interested in telling a management team to, run themselves differently. We vote with our feet, we move on, and there's plenty of other things we can do with our capital.
That's interesting. And do it's not bother meeting management? I mean, you think they're just too...
Oh, no, we do meet management. I mean, listen, before we invest, we're doing a lot of fundamental research, right? We're looking at all of the financial statements and understanding how those flows of cash have gone. We read everything they write, their shareholder letter. I like to see a management team that says, these are our objectives. This is what went well this year. This is what we've got to work on. And the next year, they say, our objectives, we've worked on these things that we mentioned last year. What I don't like is a management team that every year has a new set of objectives, or it never revisits what went wrong the year before. There's you get all kinds. So we read we listen to every conference call, we listen to every presentation, we read everything they write, and we typically either meet them in person or do calls with them before we would invest. So it's very important to us. But I also am, I have my, kind of antenna up, because as I said, it part of a CEO or an IR person's job is to make the investment community like them, believe in them, value the company. So, this is not a business where you should, in my opinion, look to befriend a management team or have them think particularly specially of you. If you want a friend, get a dog. This is not the business for someone who's desperate for friendship or approval. This is a business for someone who can maintain sort of a cold and distant analytical view of a management team. And that's important because as humans, we all like to be liked. We like to have positive interactions with people. We always try to have that, but we are also willing to ask the tough questions.
But you hold stocks for quite a long time, don't you?
It depends. If you look back in like 2009, 10, 11, 12, our turnover was higher. I would say since 2017, our turnover has been far lower. There's sort of two situations, and as we just discussed, the market was different then. There was a more active management community, and I would say 15 years ago, you were more likely to see capital come behind, a re-rating happen, and you could move on. And so there were, that was, I would say, a bigger component of our returns. And as that has declined in terms of just market structure, we have seen that it's more that a company compounds in value and the price goes up. But as long as the company is still growing in value and we still have a large enough margin of safety, we are willing to hold. And that's, kind of the reasoning behind our longer hold periods now.
Interesting.
I would say it's just as much market structure as anything else. It's not a kind of coming in and saying, we're going to own this for 10 years or we're going to own this for 5 years. That said, nothing really gets fixed quickly, right? If you're buying something that's got an issue or a company that's got headwinds, it takes, 12 to 24 months at a minimum, typically for them to get their act together.
Do you not find that you get sort of drawn to people, the longer you own the stock and if things are going well,
So I think human nature is maybe that you would. And I can't say, that we wouldn't fall prey to the same issue. We do believe in a broadly defined equal weighted portfolio. So what that means is it's sort of a guardrail against what you're talking about, which is human nature. As a stock dips, we revisit our thesis and we are more likely to buy more of it. As a stock appreciates, we revisit our thesis. We try to understand how big that margin of safety is. And if the margin of safety is smaller, we will trim it. So that helps us, to be more agnostic to the people and more analytical about the value.
Okay. But you wouldn't really be equally weighted in that. You would still be you still have different weightings in the different positions, but all be different discounts to your estimates of value, presumably.
Yeah, look, I think if a stock is worthy of you buying it, you should buy a full position.
Yeah.
And a full position for us is like 3.3 to 3.5%. In some of the accounts, it's like a 3.7% position. And we'll begin to trim. Right. And then we begin to trim at around 4.5 or 5%. Back down. And then depending if we still love the name, we're willing to hold it at a full position size and continue to hold it at a full position size. If we think the company has still done well, but maybe the stock price has gotten ahead of itself, we might trim it to a slightly smaller size.
But you would never own a position with 7% or something like that.
I'm not a 10% position kind of person. That is not what you invest in Summit Street expecting to get.
And that's from a sort of risk point of view, a risk management point of view.
From a portfolio management point of view, I think when you invest in Summit Street, you're expecting to get 30 equally weighted, 25 to 30 equally weighted stocks, roughly speaking. I think I've seen enough of my peers focus on like their 3 best ideas. If you knew what your 3 best ideas and you had a crystal ball, yeah, have at it. I don't believe there is a crystal ball. I don't believe our investment approach requires a crystal ball. And I think people, when you ask the questions about do you get attached to management or do you grow overconfident because it's your best idea, I think it's in those type of portfolio structures that is more likely to happen than, how, and I've seen enough, out of left field problems that can hit a company in my tenure that I don't believe that's necessarily the safest way to compound capital.
No, sure. I mean, I remember when I first started in the buy side, and I was asking somebody about, how many positions was the right number, and we were having the discussion, and they said something like, well, every year 3 stocks make us all our money, and if we only knew which 3. Now, look, you're a woman running a fund, and you're in the minority, really. Maybe less so in the United States than in Europe. But there aren't as many women running funds there probably should be, are there? I mean, women tend to be better investors than men, I think. Are you optimistic we'll see more women come into the industry?
I'm not really focused on gender as a thing. I mean, I do think there should be opportunities for women. Women shouldn't be shut out because they're women. I'm not sure I really buy the analysis that says women are better investors. I sort of think that the women who are in this business at my age, or or similar to my age, they've kind of jumped through a lot of hoops in a period of time that finance was very, very male dominated. Maybe they've had to jump through more hoops. Maybe the funnel's been a little tighter, and that's probably what drives the outcome of that analysis. That being said, I don't believe anybody should be shut out of an industry based on their gender. So part of the reason I do things like this podcast is to show, in case some young woman is out there thinking, can I have a career, seeing other women ahead, who've kind of been doing this for a long time, it's probably useful. But I'm a big believer that there's an approach, there's a mindset, you either get it or you don't. And maybe it's connected to gender. I can't say I've read any research that convinced me of that.
Yeah, well, I don't know if there's any evidence. I mean, it'd be quite hard to get evidence.
That's the thing. Everybody sort of quotes it. I'm not sure where it comes from.
Well, I don't know. I mean, it's a feeling I have that, I just find when I talk to women investors, they're more calm. They often seem to be more rational, less emotional. And, if I had the choice between 2 people that had identical performance and similar portfolios, and one was a man, one was a woman, I would probably give it to the woman. I mean, I don't have any analysis to back up my feeling, but it's just an experience and a feeling. But I do get a bit frustrated because I've got an online school, and this podcast has far more male listeners than female. I've got very few female students at my school, and I think, well, why is that? And I think it's good to have women guests because that encourages everything. Now,
I would agree.
Even the best value investors underperform 1 year in 3. Is that fair?
Yes. I probably 15 years ago did some analysis on, I took the investors that Warren Buffett had identified in his paper called The Super Investors of Graham and Doddsville. And I got their performance track record over time for each of them and compared it to the S&P. And pretty consistently, the value managers underperformed the S&P about 30% of the time. And over time, the S&P earned something like 9% and value investors earned something like 18%. So, as I sort of said about the crystal ball, I don't think anyone can invest well with the expectation that they can see the future. But if you can invest consistently with a disciplined approach in stocks that are worth less than you buy them for, over time, the market is a weighing machine. And in the short term, as Warren Buffett says, the market is a voting machine. So if you can take advantage of short-term, kind of fall from grace and disfavor, and buy companies that over time become more valuable, over time you will earn a lot more money. And if you invest with a big enough margin of safety, when you're wrong, you won't lose that much money. So when you think about being an investor from a probabilistic standpoint, assuming that none of us have a crystal ball, what you want is a high hit rate and a long tail, and a positive skew. So you want a high hit rate, so your winners, you have more winners than losers, and you want a positive skew, so you earn more on your winners than you lose on your losers. If you can consistently do that, you will be able to compound capital safely for your partners.
And which you've done an amazing rate. You're up sort of 8 times since you started, something like that. But you didn't have a good year last year. What did people say to you, and how do you answer their fears? Because it's really difficult for clients, isn't it, to trust you?
So it's hard, and I do think it's really important to have a great client base that knows you well and knows what you do. Your partner should never be surprised by any move you make or by anything you say. And if you've done a good job sort of narrowing down and selecting your partners, and if they've done a good job making sure, Summit Street's not for everybody, but if we're for you and you've done a good job understanding us, even a year like last year won't be an issue. So what I could say about last year is the good news is we compounded capital and we preserved capital. The bad news is the market did better.
Yeah.
So I don't think that compounding capital at 13% a year since inception is a record to apologize for. And last year, 2022, the market was down, mid double digits. We were down mid single digits, low single digits. So we protected capital. Then, in 23, we were up pretty close to the market. And in 24, I would say we had a great year until July. And then July, everybody became concerned about China. A lot of our names came in. Thankfully, we had trimmed a bunch and were able to buy, at higher prices, and we were able to buy more. We were able to put some money to work. And December was a bizarre month. I mean, if you tell me that there was a huge fund liquidating, I'd believe it. But, Mag 7 went straight up, and even financials did pretty well, neither of which are in our portfolio. So it's not surprising that we didn't keep up. But then you look at a year like this year, and we're down a whole lot less than the market. So a partner of ours needs to be special, needs to be able to have a long enough investment horizon and mindset that they don't get too bothered when markets are going straight up and trading at 45 times earnings and we're not keeping up, because it's only with that long-term investment horizon that you can then benefit when, kind of idiosyncratic stocks recover, or when these crazy, multiples become compressed and our stocks, can continue to accrue.
Your last letter said, "We believe our best times are ahead of us." Why did you write that?
Natural Optimist, trust but verify. I'm, I think that look, first of all, on average, the market goes up and we're long biased, long only, right? So on average, we will be up. And I believe there will continue to be idiosyncratic investment opportunities that are cheap and high quality and will generate attractive returns. So I am a big believer in that. I sort of look forward and think the United States is a great place to do business, a great place to invest. I do think we're going to have some interesting times, between tariffs and regulation and all kinds of things. We talked earlier, the future is unknowable, but the stocks in our portfolio and the names we're looking at are genuinely attractive companies, high returns on invested capital, excellent balance sheet and cash flow characteristics, trading at less than 10 times earnings, or 10 times cash flow.
Yeah. No, I was very taken with the stocks that you presented at the New York conference, and they were very unusual and very distinctive. And you've obviously got a knack of finding these sort of overlooked areas, which I'm curious about, but it's all down to the numbers. So I understand exactly what you're saying. We normally ask people to recommend a book to a young person thinking of coming into the industry. So is there a book you would recommend to a young woman thinking about becoming an asset manager?
There are a couple actually that I think are very valuable. First, I would say many young people do not have an appreciation for market history and understanding market history as opposed to the last 20 or 40 years is very important. So there are books like Only Yesterday or Reminiscence of a Stock Operator, both of which are old and worth reading. A book that was very formative for me was Margin of Safety by Seth Klarman, but that's a tough book to get your hands on. And then a book by Bruce Greenwald called Value Investing from Graham to Buffett and Beyond. If you believe that you'd like to learn more about the practical approach to value investing.
Who's Only Yesterday? Who wrote that?
Oh, hold on one second.
Don't worry. I'll look it up.
Yeah, well, you can find it.
And Jen, where can people find you?
So we have offices in New York and Florida. We have a website, www.ssvfunds.com. And any information that you'd like about Summit Street, you can typically get from the website, including our contact phone numbers and address.
Okay, well, we'll link to that in the show notes. Jen, thank you so much for coming on. It was a pleasure talking to you.
This was fun. Thanks for having me.
Well, we didn't even get on to passive investing, where Jen has strong views. But I loved her old-fashioned approach. Find good companies which are cash generative and sensibly managed. Don't get close to management. Focus on the numbers. Get out if things don't go to plan. And manage the portfolio according to the margin of safety. I'm looking forward to seeing her again in Omaha, where she will be moderating the panel at the Columbia dinner on the Friday night, along with two other former guests, Mario Gabelli and Beth Lilly. Let me know if you have questions for them by filling out the form on our website, behindthebalancesheet.com. Thanks, as ever, for your support. Thank you for listening. I'm Steve Clapham. That was the Behind the Balance Sheet podcast. Please don't forget to subscribe to the YouTube channel. And why not visit our website, behindthebalancesheet.com, where you can find the show notes and lots of other videos which can help you on your investing journey. Thank you for watching.